Course 7, Module 3, Reviewing the Documents. In this module, we'll review the pre-consultation worksheets. We'll go through the forms, noting what to look for, why to look for it, and how the information can be used to prepare for and during the loan consultation. Now, this is very important. If you do not receive the pre-consultation worksheets before the scheduled time to speak with the client, always reschedule. What I do in this instance is call the client at the scheduled time and reschedule. Don't worry about the client going to another lender. If they are not willing to get you the information for what is probably one of the most important financial decisions they are ever going to make, they are probably not a client you should be working with. When I make the call, I just say, "Mr. Smith, it is time for our scheduled loan consultation, but I haven't received your pre-consultation worksheets. I want to be sure that I have time to research all of your options, so let's reschedule. When do you think you'll be able to get all this information to me?" Most of the time they'll apologize, and it was because they were busy. Sometimes they are a little embarrassed that they didn't do their part. Always give yourself a full day to do the research and analyze the opportunities on the documentation in the pre-consultation worksheets. Never schedule a consultation on the same day you receive information. I would, at a minimum, recommend giving yourself a couple hours to review the information. Okay, let's say you have received all the completed pre-consultation worksheets and the documentation you requested. The first thing to do is to review the information carefully and look for boxes on the pre-consultation worksheets that are incomplete. Make sure to highlight all of them. Then check for information that may lead to further questioning. For example, the client may not be a U.S. citizen, so you may need to know some more information about their citizenship. The client may have credit issues. Now, you will have gotten permission to pull their credit report before speaking, so you will know their current credit profile. The client may also be self-employed, so you may need tax returns to verify the exact income and 2-year job history. The client may need more reserves to qualify. Whatever it may be, there are 3 very important things you should do before speaking with your client. Number 1, send your client an email asking for the information they did not provide. Now, it is possible that your client may complain a little, but as long as you explain that it is critical and necessary to doing a thorough job, they will provide you all that you need. Number 2, you are able to ask an underwriter or manager about anything you are not 100% sure about, whether it be a lending guideline, an opinion on the advice you are going to give, or if the loan qualifies or not. You may also want to call one of your referral partners to ask a tax or financial question that may be relevant to your client's situation. Number 3, you can identify key wants, needs, and opportunities to make referrals. By doing this preparation beforehand, you can put your plan together in advance of the loan consultation. I sometimes prepare an analysis before I speak with my client, showing different loan options. It gives a very nice visual of what I'm trying to convey on the call. The main point is preparation. You will be prepared for typically anything that could come up during the loan consultation. You now have the completed pre-consultation worksheets. Now I am going to walk you through each of the key questions on the application and mortgage planning questionnaire, the reasons we ask for this information, and how we use these questions to add value to the client and introduce our business partners. Before analyzing the pre-consultation worksheets, email the file called "What Makes Us Different" to the client. This is a document that describes how the Core 7 works and what the client can expect. I always encourage my clients to read it before the loan consultation. It will prepare the client for the different approach that we take. This document is in the Resource Center and can be customized so that you can use it also. So let's walk through the application. It is basically a loan application with a few extra valuable items that will enable you to do a more thorough job on the loan. You will be able to identify key cross-selling opportunities to refer your partners or meet new referral partners, and most importantly, create a deeper relationship with your clients. This approach is based on relationship selling, not transactional selling. Okay, let's start with the borrower section of our application. This section covers the basic information on the client. However, it goes further by asking the names and birthdays of the client's children. A person's child is what they care about most. So when one of our clients' children has a birthday, we like to send a nice card with some stickers or a gift certificate to McDonald's. Just asking people about their kids by name shows that you care and don't just view them as another commission. Next is the borrower's residence information. This is very similar to a regular mortgage application. Here, you are looking to see if you have a friend or acquaintance who lives near them, or something about their neighborhood that is interesting. You are looking for a reason to connect. You are trying to find some common ground to produce a stronger relationship and more trust. Next is the employment section, which you want to pay particularly close attention to. First, look to see if you know anyone at the company, maybe a friend or past client. You are looking for someone who could possibly be a third-party endorser of your services. Also, look where the company is located and see if the company may be a good candidate for our corporate lunch and learn program. We offer benefits and discounts for the employees, and we conduct seminars on home buying, financial planning, tax planning, estate planning, and much more. There is a whole presentation based around our Core 7 process in the Resource Center. It includes the email introduction, a description of the program, and other materials offering discounts and other benefits. Always obtain the name and email address of the Human Resource Manager so you can ask if there is any interest in our program. This is a simple email that can be sent out on every loan that goes into process. Next is the assets section. Look for the type of accounts the client has invested in. This type of information can tell you a lot about the client's investment philosophy and risk tolerance. Things to note are, do they have 401k and are they maxing out their pre-tax contributions? Are all their investments conservative? For example, savings accounts, money markets, or CDs. Are their investments more aggressive, like mutual funds or individual stocks? Are they a risk taker or very conservative? Is their money managed or do they do their own investing? Many times, this information can tell you a lot about what loan products and options to offer. If they are only invested in conservative investments, for instance, this might be an indication that they want a fixed rate mortgage and would be uncomfortable with any type of adjustable rate product. The next section is the source of down payment. This is fairly straightforward and a lot like a standard application where we are verifying if the down payment complies with the lending guidelines. What you are primarily looking for is if they are getting a gift and the amount of the gift. The reason for this question is if the client is getting a large gift from a relative that exceeds the maximum yearly gift limits, it could have an effect on the taxing of the donor's estate. I have had many situations where the donors have had an issue with having to fill out our gift letter. I proactively recommend the estate planning on my Core 7 team if they do not already have one. Estate planning guidelines change every few years, but usually the gift guidelines don't have any drawbacks except for the very wealthy with estates in excess of $3 to $5 million. This is a great way to introduce the estate planning attorney on your team. The next section has to do with how the clients have filed their taxes. This just asks some questions up front that, if not answered now, could possibly cause some big problems later on in the loan process. Next is the real estate owned section. This section helps identify opportunities to refer your insurance partners and to ask about the relationship with their real estate agent. Many times you can find refinance opportunities and address whether the client is properly insured. Now let's move on to key questions from the next form in the Core 7 referral system, the Mortgage Planning Questionnaire. This is, in my opinion, the information that really makes the whole Core 7 system click. Let's walk through exactly why and how to use the information obtained from it. Most of the time, you only need to find one key area to make a strong introduction to one of your business partners, but we are going to cover each opportunity. Section 1 on the questionnaire deals with your client's current housing payment. What is your current rental payment or current mortgage payment? Here you are looking for an indication of what the client's payment shock may be. You want to be able to calculate the actual change, including the tax break they will receive, because they can deduct the mortgage interest and the real estate taxes. Many times clients, especially if they have never purchased a property, calculate their whole spending budget down to the last penny, but base their cash flow projections on their old rent or mortgage payment. Most of the time, they don't factor in the valuable tax deductions they will receive from buying their first home or the increased tax deductions from buying a more expensive home with a larger mortgage. Question number 2. How long do you plan to own this new property? This question usually leads to further analysis and identifies advice your clients will need. Many times clients answer that they're going to live in this home forever. Many times this is true. A person may live in the same home forever, but may not be in the same mortgage loan forever because of changes in their lifestyle or circumstance. This question can lead down a line of questioning regarding their future lifestyle and family needs. Some examples are you planning on doing any major construction or renovation in the future? Do you plan on having children, or do you plan on having more children? Is it possible you may need to add a new bedroom? Where would the money for the renovation come from? Is a construction loan to fund a renovation possible? Are you retaining the property for investment income after you move to another home? If this is the case, there needs to be a conversation around locking in the lowest fixed interest rate and possibly buying the interest rate down with points, because it would be very unlikely to be able to obtain better financing terms when the property is considered an investment property after the client moves out. So it may be best to lock in the lowest fixed rate even though the client may only be in the home for 5 years. Your client will be in the loan for 30 years, so spend some time on this question. What is the maximum monthly payment that you feel comfortable with? We ask this to get a basis of the client's comfort level and a starting point for how much of a loan they want. Most of the time, this number is a bit lower than what they can actually afford. This is great for them, provided they can find a home to their liking in that price range. Always let the client know you aren't trying to push them to a higher loan amount. Your job is to give them all the information they need to make an informed decision. Question number 3. Are you familiar with how the tax advantages of a mortgage work? Most often, clients select a maximum monthly payment value because they are not 100% familiar with the mortgage's tax advantages. Most clients, even the most educated, fall into one of 3 categories. Number 1, they don't understand the tax benefits of a mortgage at all. Number 2, they understand that there are benefits, but are unsure exactly what they are and how they benefit from them. Number 3, they clearly understand the benefits, but haven't equated it to the actual amount they will save. It is your job to show them how to look at the benefit and the actual savings they will receive. You will either help your client feel more comfortable and confident with the monthly payment they chose, or they will realize they are being too conservative and there are more benefits than they have considered. Now let me repeat. You are not trying to push people to buy more home and overextend themselves. But many times, an extra $20,000 to $30,000 in purchase price can be the difference that gets people to that neighborhood they want or allows them to buy a home with that extra bedroom they need. These are the little differences that can help clients reach their goals. Helping clients feel more comfortable with a payment is a real value to your real estate agent partner. You are helping them sell more houses. And again, it's not about using tactics to push people into borrowing more or to make poor financial decisions. It is about helping people meet their needs as well as to make smart financial choices. Sometimes showing the savings helps the client feel more comfortable that they can finance more. Therefore, they are able to keep more money invested in an emergency account or to do work on the home. I always let my clients know a rule I call the $10,000 rule. It states that every $10,000 financed is equal to about $50 a month in a mortgage payment, and even less if you factor in the tax benefit. Keeping enough savings in cash reserves and investments ties into the next question. Question number 4. Do you feel that you have enough readily available money necessary to get through a 3 to 6 month financial setback or emergency? This is very important. You want your clients to have an adequate emergency fund in place first. This gives necessary protection in case of a job loss or another financial setback. Many of my clients answer that they have enough savings to get through a financial setback, and then I verify on their loan application that they will only have 2 months of savings left after they close on the loan. If you care about your clients and are truly doing a good job integrating the mortgage into their overall financial plan, you need to address this and have a discussion about increasing their cash reserves. You want clients to have 3 to 6 months of expenses in a liquid account. A good rule of thumb is 3 months for a salaried W-2 wage earner and 6 months for a self-employed person or someone who relies primarily on bonus or commission income. After addressing cash reserves in the loan consultation, ask, what if you were to become disabled? Do you have adequate disability insurance? This is critical because often clients will say they have disability insurance through their employer. Many times, those policies don't cover everything that is necessary for all disabilities. It is your job to suggest that they speak with the financial advisor on your team to explore this and verify they have adequate coverage. The two biggest causes of foreclosure are job loss and disability. That is why people need an emergency fund and adequate disability insurance. The emergency fund and cash reserves protects against the risk of job loss, and the disability insurance guards against if you were to become disabled. Addressing cash reserves and disability insurance may be one of the most important responsibilities of the Core 7 mortgage originator. Question number 5. Have you started planning a college fund for your children or grandchildren? If this is important to your client, you can discuss different college plans during the consultation and refer the financial advisor on your team. There are many things to consider when deciding between student loans, financial aid, and college savings plans. Question number 6. Do you contribute to a 401k plan through your employer? This is a big question with a ton of opportunity to help your clients. Many people do not take advantage of their 401k options at all, and the ones who are, many do not contribute the maximum amount. This is great to know, especially when a client is doing a no-cost refinance where the client saves $50 to $100 per month. Many clients initially don't think $50 to $100 is enough savings to go through the tedious refinance process. However, if they are not maxing out their 401k, you need to explain to your client that they are saving $100 a month, but that is after taxes. They must earn $150 a month, roughly, to net $100 a month after taxes. So it makes sense to increase your 401k contribution by $150 a month because 401ks are invested pre-tax. This concept makes even more sense if the client had no problem making their mortgage payment before the refinance opportunity. This is very easy to show with a software program called Mortgage Coach. It allows you to show what an additional $150 401k contribution could grow to over the time they have the mortgage. It is very powerful to show the difference this can make. Suggest that the client speak with a financial advisor to decide what to do with their savings. Showing the 401k example is only one option. Maybe this is freed up cash flow that can be used to purchase additional life insurance or disability insurance. It could be used to pay down credit card debt or other consumer loans. The main point is that this particular question about 401k contributions can make it easy to raise these questions where you are able to add value to the client and possibly make an introduction to the advisor on your team. Question number 8. Do you feel you are saving enough to retire comfortably and fund other investments? For example, children's college education, real estate, etc. This question reiterates what was discussed earlier and gives you the opportunity to make introductions to your Core 7 team of advisors or to demonstrate your expertise. If the answer to this question is no, or the client is unsure, make sure that during the loan consultation, you take the opportunity to say, Mr. Smith, I noticed on your mortgage planning questionnaire that you are unsure if you are saving enough to retire comfortably. Would you mind if I made the introduction to the advisor on my team? I think it will be time well spent. Question number 9. Do you currently have a realtor? And if not, can I refer one? This is a pretty self-explanatory question, but is a good lead-in to introduce your Core 7 realtor, especially on a refinance loan. You can make the introduction for a comp check and value opinion, especially when you need to know the value necessary to see if the loan is feasible. The script for this is, Mr. Smith, I really like when my clients have a resource to check the value of their home to know where they stand. How is your relationship with your realtor? If the clients do not have a relationship with a realtor, simply ask them, would you mind if I made the introduction to the realtor on my team? I think they will be a valuable resource. Also, let your clients know why your partner is willing to take the time to complete this equity assessment to help them. Tell the borrower, my realtor partner does this first of all to help me provide a great service to my clients. Secondly, this helps him establish a relationship with quality people so that if you, a family member, or a friend were buying or selling a home, you would consider him for the job. Does that make sense? They almost always say that's fair or absolutely. This is a great way to generate referrals for your realtor partners. On a side note, if the client has a realtor that they work with and trust, ask if you can reach out to that realtor to discuss the same concept. It is a great way to grow your network and help your mutual clients who may be trying to refinance. Question number 10. Please rate as objectively as possible on a scale from 1 to 10 your current level of satisfaction with the following professional areas. 1 being very dissatisfied, 10 being very satisfied. If you do not have one, please leave blank. This is the question you are most interested in. It creates amazing opportunities to refer your team, build your network, and assist in building your team's network. Here's how it works. There are 3 possible answers the client can give. Number 1, they do not have an advisor. Number 2, they have an advisor, but give them a low rating. And number 3, they have an advisor in place that they rate highly. In the first scenario, if they don't have a key advisor, refer someone on your team. The scripting to use is, Mr. Smith, I noticed that you don't have a financial advisor. I feel it is so important to have your whole financial team in place. Would you mind if I made the introduction to the financial advisor on my team to help create wealth for you and your family? Let me repeat. Mr. Smith, I noticed that you don't have a financial advisor. I feel it is so important to have your whole team in place. Would you mind if I made the introduction to the financial advisor on my team to help you create wealth for you and your family? In the second scenario, if they give their advisor a low rating, you should also introduce someone on your Core 7 team. The scripting for this introduction is, Mr. Smith, I notice you rate your financial advisor only a 3. Why is that? Get your answer, then continue by saying, that concerns me a little. Would you mind if I referred the advisor on my team who is always rated a 9 or a 10? I think it will be time well spent to speak with him. The last scenario is if they give their current advisor a high rating. In this situation, you have 2 options. Number 1, you can try to meet them to build your own network. The way to go about this is simply to ask, Mr. Smith, I see you rate your financial advisor a 10. I specialize in working with financial advisors. Would it be okay if I could call your financial advisor and introduce myself? It is really that simple, because you may need to contact their advisors directly to obtain documentation you would need for the loan anyway. Number 2, you can connect the advisor with one of your partners. For example, let's say your client has an accountant who they rated highly. Wouldn't that be a great business associate for your financial advisor? As we covered in the Referral Pathways module, because of the nature of the business, introductions between various professionals can be very valuable. This is a huge takeaway for the mortgage professional. If you can be the partner who can introduce your team members to these professionals who are in position to send multiple referrals, that is how you can become really valuable and make a huge difference in their business and their lives. Question number 11. Do you have life insurance protection? You will always be able to add value for your client here if you do a quick analysis before speaking with them. Life insurance at the time of someone's death should at least be able to pay off all of their debt, possibly pay for college tuition, and replace the income of the person who passed away. Total up these numbers before you speak to your client. This is another reason to always get everything up front before making any recommendations. Other considerations are how many mortgages need to be paid off. How many children do your clients have that will be going to college? How much income would need to be replaced? Total up these numbers and you will know a rough ballpark of the amount of life insurance protection that is needed. Sadly to say, this number is usually higher than the amount they actually have at time of application. The first thing to do is ask permission to ask a very serious and personal question. The answer is almost always yes. Then simply ask, do you feel you have enough life insurance that if something happened to you, your family would be able to survive financially? Let me repeat that again. Do you feel that you have enough life insurance that if something happened to you, your family would be able to survive financially? The answer you will usually receive is that they are not sure or that they just do not know. Let the client know that you are not a life insurance expert and that you really know enough to be dangerous, and then suggest they speak with the financial expert on your team to review this. The way to say this is, Mr. Smith, there's no obligation, but would you mind if I made the introduction to the advisor on my team? I think it will be time well spent. One of the themes you may notice in the Core 7 scripting is that you are just bringing up possibilities that your clients may want to investigate. Always let your clients know you are the expert in mortgages only, not financial planning. But it would be time well spent to speak with the financial advisor you are going to recommend. Now, this is huge. If your clients already have a financial advisor, always suggest they get in touch with them right away to address this possible financial concern. Let me ask you a question. Do you think your client's financial advisor would appreciate it when you call to say, "How are you? I'm working with the Smiths on their mortgage financing, and they are wondering if they need to increase their insurance coverage. I am going to send an email reminder to them with you on it to make sure they address it. Is that okay?" You bet they appreciate it. As a mortgage originator, it is important to get your clients thinking about the key insurance questions they should ask their financial advisor. For example, it is also critical that when a client is purchasing a new home, if they are a first-time home buyer or a move-up buyer, that they need to consider obtaining insurance to cover the new debt or to increase their existing coverage if they have taken out a larger loan. The same conversation is needed regarding disability insurance. Simply ask, if you were injured and unable to work, would you be able to pay your mortgage? Let's stay with disability insurance, but this time the loan is a refinance where you are able to help a client free up cash flow by lowering their interest rate. Each time this is done, an analysis of their insurance needs should always be addressed. The cash flow that is freed up could be used to purchase the disability insurance to protect the client if they were ever injured and unable to work. This is important to know and ties in with question number 4 on the mortgage planning questionnaire that asks about having enough cash reserves to get through a 3 to 6 month financial setback. Most disability policies have a waiting period of usually 90 days before paying the client any money. It is very important to have 3 to 6 months of reserves so the client can pay bills while waiting for this disability income to kick in. The bottom line is that any time a refinance takes place where monthly cash flow is increased, there is always the opportunity to do something positive for your client's overall financial picture. Question number 12. Do you have an umbrella policy in place? An umbrella policy protects assets primarily against lawsuits. It is something that many people don't have and are unaware of its value. The absence of an umbrella policy can completely wipe someone out financially if they are sued. For example, let's say the client is at fault in a car accident where the person in the other vehicle is badly injured. That person may be unable to work because of their injuries and forced to sue the client if their homeowner's insurance policy doesn't cover all of the damage. All of their personal assets would be at risk. The umbrella policy would protect the client in such a situation and is usually only a couple $100 per year. It can make all the difference. This is well worth bringing up when speaking with a client about refinancing where the monthly savings does not seem to be that significant to them. Always bring up the umbrella policy if they don't already have one. The monthly payment for a policy breaks down to an average of approximately $15 a month and can many times be the best investment somebody makes. Number 13, have you created a will to protect your family's assets and care for your loved ones? More than half the people in the United States do not have a will. If you don't have a will when you pass away, your estate will need to go through probate, where the court decides what to do with your estate. When a client purchases a home, it is our job to remind them to put their new asset into their will so it will be protected and pass on to the recipient, avoiding the lengthy probate process. Probate can also be very expensive. It's definitely not something someone would want their loved ones to go through while they are in mourning. Discussing someone's will and estate also leads in to asking if they have a health care proxy and durable power of attorney in case they are incapacitated. They will need to have someone to make decisions for them. These are very valuable points where just a simple reminder can save so much grief for your client and their family later on in their lives. Question number 14. What is most important to you about working with a lender? This will let you know what your client is thinking and can help you serve them better. The most common answers are a low rate and a low payment, trust, patience, a lender that answers all my questions clearly, no last-minute surprises, to know what we qualify for without overextending ourselves, and a lender who is knowledgeable. These are pretty simple answers. Very rarely do clients say they want the mortgage integrated into their overall financial plan. That is why it is our job to make them aware of what they need financially. Question number 15. Have you recently spoken with other lenders about home financing? If they have spoken with other lenders, you want to know who you are up against. This is where knowing your competition and your competition's loan products can be very important. If you know of an advantage or disadvantage that another company has, you will know how to direct your presentation. Remember, the Core 7 is built on referrals, so usually, as long as what you're offering is competitive, you will win the client. That's why having all the information you can up front is so important. Question number 16. What hobbies do you enjoy? You want to know your client's hobbies and interests so that you are able to connect with them more. You can use the information to send out interesting articles and information you find on their hobbies. This is just another way to connect and build trust with your client. I will tell you, when you send a random article or anything to do with your client's hobbies and include a personal note, there isn't much that makes a bigger impact. Now, questions number 17 to 21 only apply to refinance transactions. They are fairly basic and self-explanatory, but still can be very critical in your presentation. Question number 17. If there are closing costs, would you like to incorporate them in the loan amount, or would you prefer to pay them out of pocket? This is a qualifying question because the term no closing costs refinance in the mortgage industry is a term that is not clearly defined. Many originators present it differently, so it has different meanings. Always make sure to ask the client if they want a no closing cost loan with the cost financed in the loan amount, or a true no points, no closing cost loan where all the costs are paid by the lender. It is important to find out what the client's understanding of this topic is before making any suggestions or presenting a program. This question ensures that the client is assessing an apples-to-apples comparison. Question number 18. Have you made improvements to your home that would affect the value? Obviously, you want to have a decent idea of the appraised value before making any recommendations. If there were any improvements, suggest the client speak with a real estate agent on your team regarding the value before starting the refinance process. This is true especially if a certain value is important to determine if the client should refinance or not. Again, it is an excellent service for your clients and also a great way for you to generate referrals for your realtor partner. Question number 19. Do you plan to pay off a home improvement loan or a second lien with this loan? This is something you need to know in order to price the loan as a rate and term refinance or a cash out refinance. As you know, cash out refinances can sometimes carry a higher interest rate. It is always better to be able to research the loan program and loan structure before presenting to the client. Question number 20. How long since you last financed or refinanced this property? This question provides more important information to help you determine if a refinance makes sense. Question number 21. What are you trying to accomplish with this refinance? Obviously, this gives you a little more detail and clarifies what the client is trying to accomplish. Although this is simple, it can be very important to know this before you speak with the client. You can look up information on the client's needs and do extra research to strengthen your presentation. Question number 21. Who should my team and I consider as the primary contact throughout the loan process? This question tells you who the best contact is. This will also cover you if your client ever tries to blame you for not communicating with both people. This comes up much more frequently than you would think. The next form we are going to review is the documentation checklist. This details the documentation that will probably be needed for the mortgage loan. It is a pretty standard document that all mortgage originators use in some capacity. As we have repeated throughout this course, it is always a good idea to get as much of this documentation up front before doing the loan consultation. Now, I want to make a very important suggestion. When you have received this paperwork, review it briefly for a few important details. Now, most mortgage originators, other than making sure the income is calculated correctly on the tax returns, don't look at this information at all. We just send it in. We are all a little guilty of this, and it is somewhat justified because the main focus of a mortgage originator should be on bringing in more loans, networking, advising clients, and cross-selling your business partners. However, I would like to point out 4 steps to do for the loan consultation that can really make a difference and avoid some last-second hurdles. This may seem like Mortgage 101, but it is a simple habit that has made a big difference for me. Number 1, check the bank statements for any large deposits that are not payroll deductions. These deposits have to be verified, so address them up front, or at least let your client know they may need verification. In my experience, the last-second scramble to show a paper trail sourcing the large deposits can be one of the most frustrating things for the client. Circle all the deposits and send them to the client with a note saying the underwriter may request verification. Number 2, check the client's pay stubs for any 401k loans or child support that are deducted directly out of the paycheck. These payments may not show on the credit report and will be calculated into your client's debt-to-income ratios. You don't want to miss them because it can affect whether the client qualifies for the loan or not. On a side note, it is also a good way to verify if the client contributes to their 401k. As we explained earlier, there are a lot of opportunities to add value by showing the client how to contribute more to their retirement funds. Number 3, verify the income you can use to qualify and check for any 2106 non-reimbursed business expenses on the Schedule A if you have their tax return. These need to be deducted from the income that you can use to qualify. Also check if there is any depreciation if the client is self-employed or owns rental property, because that can be added back to income. Personally, I have been able to qualify a lot of loans that other companies declined because I was able to add depreciation back to the client's income. Most mortgage originators already know this. And there are still many other things that underwriters are going to want to verify. The fact of the matter is that mortgage originators are constantly focused on new sales and typically aren't going to analyze the documentation in much detail. Most originators are just going to send the paperwork they receive from the client to the process without review. These steps help make mortgage originators more efficient. Question number 4. If the customer is self-employed, check if there are any Section 179 business expenses. This does not have anything to do with qualifying for the loan, but is a great way to add value and create stronger relationships with your clients. Many times this section is blank. Often accountants are so busy doing tax returns within such a small window of time that this key write-off is not addressed. If it is blank, just ask your client, have you purchased any computers, laptops, scanners, printers in the last year? Business expenses like these can be written off. I once helped a client get $2,000 back on their taxes because he had purchased 2 computers, a scanner, and a printer and hadn't claimed these under his 179 business expenses. Think about that. I saved him $2,000 just by taking a minute to check for this on his tax return. Do you think this client cared if my interest rate was 1/8% higher than the competition? Not at all, because he knew I was looking out for his financial interest. Interest rates are not something that an originator can control. Sometimes you may have the lowest interest rate, and sometimes you won't. If you only sell interest rate, you are at the mercy of the market. You need to look for ways to add value to the client's overall picture. That is always the difference maker. In this module, we reviewed the pre-consultation worksheets in detail. We reviewed what information is on the forms, why the information is needed, and how to use that information to prepare for the loan consultation. We also talked about specific things to look for that indicate opportunities to add value for the client or to refer a Core 7 partner. Now you have gathered and analyzed all of the information needed to give the best advice and build trust. You are ready to do the consultation, which we will go over in the next module.